A recession is looming. America is frantically searching for ways to protect their dominance, all while one proposal is gaining acquired traction. Its goal? To weaken the US dollar, counter China's growing influence, and restore domestic manufacturing. My name is Peter, and I'm a senior analyst at Trading Key. In this video, we will explore what exactly the Mar-a-Lago Accord is, how it might work, and what it could be for the markets. Before we get into the mechanics, let's take a step back to understand the backdrop. The Mar-a-Lago proposal takes inspiration from 1985 Plaza Accord, a historic agreement between the US, Western Europe, and Japan to weaken the US dollar in order to address trade imbalances. The coordinated devaluation successfully boosted US exports and shifted the global economic order in America's favor. The Mar-a-Lago version, however, seems far more unilateral. The idea was first outlined in November 2024 by Stephen Myron, who now serves as the chairman of Trump's Council of Economic Affairs. While Trump has not publicly endorsed this policy, some of the past trade positions suggest a high likelihood of alignment with this direction. At its core, the proposal serves to depreciate the US dollar, restore domestic manufacturing, and address America's debt. This revolves around several key policy tools. Tariffs seem to be the cornerstone of the strategy. By applying pressure on foreign counterparts to appreciate their currencies, encouraging manufacturers to relocate production back to America, and generating tariff revenue, tariff may provide fiscal space for tax cuts. The Accord also outlined a debt management component. This includes converting existing US Treasuries into long-term bullet bonds of potentially 100 years of maturity. This move may allow the government to delay interest payments and reduce immediate fiscal strain. Another element involves soliciting US allies to fund more of their own defense. By reducing America's defense spending abroad, more resources could be reallocated towards domestic economic programs. Ultimately, the plan proposes the creation of a US-controlled sovereign wealth fund. This fund would intervene in the forex markets by buying foreign currencies, a tactic designed to weaken the dollar by direct market intervention. The desired result of the accord would be downward pressure on the US dollar. A weaker dollar would make American exports much more competitive abroad, thereby increasing demand for US exports and, by extension, global usage of the dollar. In parallel, US Treasury yields could also fall. From a market perspective, major US stock indices like S&P 500 and Nasdaq may remain resilient. Large-cap tech firms could continue to perform well, especially if AI tailwinds persist. The manufacturing, banking, and energy industries likely stand to benefit from these structural shifts. Many small and mid-cap industrials are already operating domestically within the US, which means they wouldn't face the same relocation cost as their multinational counterparts. As a result, they may be an early beneficiaries of manufacturing incentives and capital inflows. Plus, a shift towards domestic industrial investment would also likely increase demand for capital. This could benefit the banks through increased issuance of equity and debt instruments. Moreover, reindustrialization would require a reliable and large-scale energy supply. This could create upside for companies in oil, gas, electricity, and even renewables. With all this said, the main question remains: is the Mar-a-Lago Accord feasible? In today's global context, US influence may not be strong enough to compel cooperation. China and other BRICS nations are increasingly assertive in shaping their own way of economic order. Any US attempt to isolate them economically could face resistance. Even if countries wanted to adjust their exchange rates, today's financial markets are far more complex and liquid than they were back in the 1980s. Central banks may lack the tools necessary to influence currency values in a sustained way. Additionally, reviving US manufacturing would be a major challenge. Labor shortages and high wage expectations mean that Americans are not willing to take up industrial jobs. Moreover, the upfront investment needed to rebuild factories domestically would be substantial. This could put pressure on the very debt burden the policy aims to reduce. Ultimately, only a small portion of debt is held by foreign investors. The challenge lies in persuading private investors to restructure Washington's debt, who may not accept lower interest payments without demanding a higher risk premium. So where does that leave everyday investors? The Mar-a-Lago Accord is a hypothetical strategy and not an official policy, but it reflects a growing line of thinking among certain US policy circles. The weaker dollar, trade protectionism, and debt restructuring could form the foundation of a new economic model. Would this ever become a reality? It's hard to say. But the debate it sparks may shape the next chapter in global economic policy, whether it's through direct action or the anticipation of it. If you found this breakdown helpful, don't forget to hit the like button and subscribe to our channel. And remember to stay informed and stay ahead. Link to all of our socials is in the description. See you next time.